What if I told you there's investors that get paid millions of dollars every single year, not because they trade stocks every day and not because they time the market perfectly, but simply because they own a great business? In fact, one of the greatest investors of all time has earned hundreds of millions of dollars every single year from just one stock, and that is Coca-Cola. And that's without selling a single share. That investor is Warren Buffett. And today, I'm going to show you exactly why dividend investing works and why Warren Buffett loves it and how you can start dividend investing step by step, even as a complete beginner. What's up, everyone? Welcome back to the channel. Do me a quick favor, hit the like button, subscribe, and share this channel with a friend. I'm really trying to grow this channel and everything helps. On this channel, I break down money, investing, business, and long-term wealth building in a way that's practical and easy to understand. All right, let's get into dividend investing. What is dividend investing? Let's start simple. Dividend investing means buying shares of a company that regularly pay you a portion of their profits, called dividends, just for owning the stock. Most dividends are paid quarterly, which means 4 times per year. So instead of only making money when the stock price goes up, dividend investors get paid real cash deposited directly into their brokerage accounts simply for being owners of shares. You don't need to sell your shares. You don't need to trade. You don't need to watch the market every single day. You own the business and the business pays you. Why do most people invest in dividend stocks? First, it's a steady income stream. One of the biggest reasons why people invest in dividend stocks, it's because it's steady, predictable income. Dividends grow. Dividends provide regular cash flow, often quarterly, which makes them especially attractive for investors who want to build passive income, retirees who want income without selling any shares, and anyone who wants cash alongside with growth. This income can be used to pay bills or reinvest into the same stock or other stocks, or simply build financial flexibility. The second reason why people invest into dividend stocks is compounding growth through reinvestment. This is where dividend investing becomes extremely powerful. When you reinvest your dividends, instead of spending them, you use that same money to buy more shares. Those new shares then generate more dividends, which buys even more shares, and the cycle continues. This is compounding in action. Over time, your portfolio doesn't just grow from appreciation, it grows because your income itself is growing. That's how small investments turn into massive portfolios over decades. The third reason why people love dividend investing is because it offers lower volatility and stability. Companies that pay consistent dividends are often mature, they're profitable, they're well-established, and financially disciplined. Because of that, dividend stocks tend to be less volatile than high-growth stocks. During market downturns, dividend-paying companies often fall less and still pay you while you wait. That stability helps reduce emotional investing and panic selling. The fourth reason why people really like dividend investing is many strong dividend companies increase their dividends over time. That means your income rises year after year, helping protect your purchasing power against inflation. Compare that to cash sitting in a checkings account losing value every year. They are a good sign of good financial health. A company that consistently pays and grows its dividend is usually signaling it has strong cash flow, reliable earnings, and its shareholder-friendly management. Companies can't fake dividends long term. If they pay and grow dividends for decades, it usually means the business itself is strong. Overall, it has strong long-term total returns. Dividend stocks offer what's often called 1-2 punch: income from dividends and growth from stock price appreciation. Over long periods, this combination has historically produced strong total returns, often outperforming non-dividend paying stocks. There's also tax advantages. In many cases, qualified dividends are taxed at a lower rate than ordinary income. That makes dividend income more tax efficient than interest from savings accounts or bonds, especially when combined with tax advantage accounts like Roth IRAs. Now, it's important to be honest, dividends are not guaranteed. Companies can cut dividends, they can freeze dividends, and even suspend dividends. This is why quality matters. Chasing the highest yield often leads investors into trouble. A high yield can sometimes be a warning sign, not an opportunity. That's why we focus on sustainability, not just yield. Here's how to get started dividend investing if you're interested. First, choose the right account. You can invest in dividends through a tax brokerage account, a Roth IRA, or a traditional IRA. Roth IRAs are especially powerful because qualified dividends grow tax-free. Define your goal. You need to ask yourself, do I want income now or do I want it later? Am I reinvesting or living off these dividends? Is this for retirement or is it long-term wealth? Your strategy should match your timeline. Decide how you'll invest. You have two main options. You can choose individual dividend stocks or you can choose dividend ETFs. Many beginners start with ETFs for diversification, then they add individual stocks later. Here's how to pick a good dividend stock. First, don't chase yield. Extremely high dividend yields are often dangerous. A sustainable dividend is better than a flashy one. Look at the dividend history. Consistency matters. Companies that have paid dividends for decades show discipline and resilience. Understand the payout ratio. The payout ratio tells you how much a company's earnings are paid as dividends. Lower or moderate payout ratios are usually safer. Analyze their financial health. Look at revenue stability, earnings consistency, cash flow, debt levels. Dividends come from cash, not promises. Dividend aristocrats are companies that have increased their dividends every single year for the last 25 consecutive years. These are some of the most consistent and reliable dividend players in the market. They aren't flashy, but they've been proven. Now let's talk about Warren Buffett. Buffett doesn't chase hot stocks. He doesn't trade in and out. He buys great businesses and holds them for decades. One of his most famous dividend investments is Coca-Cola. Let's go over a Coca-Cola example. Warren Buffett started buying Coca-Cola shares in the late 1980s. Berkshire Hathaway owns hundreds of millions of shares of Coca-Cola. And here's a key part. Because Coca-Cola has consistently raised its dividends for decades, Buffett now earns over $700 million per year in dividends from Coca-Cola alone. Let that sink in. He invested once, held the stock, reinvested, and stayed patient. And now Coca-Cola sends Berkshire Hathaway hundreds of millions of dollars every year, regardless of what the stock price does. Buffett has said many times that his favorite holding period is forever. Dividends reward patience. Let's go over why Warren Buffett loves dividends. Because they produce cash without selling, they reduce reliance on market timing, they reward long-term ownership, and they reflect strong businesses. Buffett's dividend income today is dramatically higher than when he first started investing, even though his original cost basis was far lower. That's dividend growth in action. Comparing dividend stocks versus dividend ETFs, dividend stocks, they have higher control, they have potentially higher income, and more research is required. Dividend ETFs is instant diversification, lower risk, and it's ideal for beginners. Many investors use both. There's plenty of tools out there to do research on these dividend-paying stocks or ETFs. You can do research on dividend stocks by using brokerage screeners, dividend history tools, and financial statements. Focus on the dividend growth, the payout ratio, and financial stability. Here's a couple of common beginner mistakes. They chase high yield, they ignore the fundamentals, they don't reinvest early, and they panic sell during downturns, and they lack diversification. You can build a simple dividend portfolio as a beginner with core ETFs and a few high-quality dividend-paying stocks, and use automatic reinvestment for your dividends that you earn. Consistency beats perfection every time. Dividend investing is not exciting, it's slow, it's boring, but it works. Warren Buffett didn't get rich overnight. He got rich by owning great businesses that paid him year after year. Dividend investing rewards patience, discipline, and long-term thinking. Start small, stay consistent, let time do the heavy lifting. If you found this video helpful, hit the like button and subscribe for more investing and wealth building content, and comment below. Are you investing for income now or later? I'll see you in the next one.